Good day, investors. Today I'm following the theme of looking for value in overlooked places. So let's look at Telkom Indonesia. It's Indonesia's leading telecom business, which is majority state owned. It's essential for the country's development, and its moat is coming from that direction. So it has a dominant market share, extensive infrastructure, strong trust locally, and high customer switching costs. Management, given it's a state bag, you can expect they are balancing development goals with shareholder returns. Of course, the government being the majority shareholder with 52% of the shares. They also want to receive dividends while also maintaining projects, so they don't want to cut back on capex. So they have to balance that, but I would say they are doing a great job with that so far. Financially, it's really solid with manageable debt, nice cash flows, nice dividends, nice dividend payouts. We will see it on the other side. And I would say they are offering a moderate and to good long-term safety return. And with that, if you look at meaning side, as said, 52% government owned, 48. This is the key, public, and of that 48, 80% is foreign, and of that is basically foreign institutions. So I would say I also saw this company in a 13F report of some investors I follow. I cannot recall who exactly. Maybe it was Peter Schiff or it was Michael Burry. But the point is that not just those guys, but usually institutions and pension funds, insurance companies like to have companies which are like bond-like a bit. So you have a predictable business and nice cash payout. So this is something, if you will read the Benjamin Graham book of the Intelligent Investor or the stock analysis, security analysis book, he would mention like nice dividend payouts of at least like 60% of net income. Is that something a shareholder should be entitled to? So this is that type of business. It's not high growth, although it has to spend relatively a lot on capex just to stand still. So it's like a railroad company has to spend a lot on its maintenance, and then you have to spend on growth. I would say they are not overspending, so we'll see that later. So they have a really nice payout, relatively stable business, so it's understandable that institutions would invest in something like this. It's a bond like with higher yields. Of course, it's the backbone of Indonesia's digital industry, digital infrastructure and connectivity, so it's part of the country's development. And then you can see the segments here. I have some numbers on the other slide. If you want to read these, just pause the video and read through. So operating results. One issue when I was analyzing these companies is that everything is in rupiah and the exchange rate is kind of crazy to the dollar. Although I managed to do it, these numbers are in billions, so you can grasp the exchange between USD and rupiah. The majority of the business is mobile. Then you have consumer, enterprise, and VIB. And if I jump back here, you can identify these. And of course, corporate, another that's a net negative. But you can see they are really heavy on mobile. They are growing. They are connecting the country, so it's relatively in a good spot to grow. And if you look at the Q3 25 capex update, what they are looking for is focusing on connectivity. They have some legacy to probably maintain, platforms and services. 5-year capex trend. So that's what I was saying, that they want to have a capex to revenue of, I think on the guidance they say to 20 to 30% of revenue should be capex. That's actually not as high as one would expect. So it's relatively nice. And then you can see that already 24 they cut back on capex. So that's a shareholder friendly approach to reevaluate and balance profitability, right? So if you have a weighted average cost of capital of 10%, then you don't want the company to invest in projects which are 5% return on investment, despite maybe the country likes would develop. Because I would say, as a free market guy, if your weighted average cost of capital is 10% and the return investment would be 5, then the country would be better off you do with the money something else. And you can see that 24 was already lower, and then the 3-month trend is already lower compared to a low 24. So that's a nice trajectory. leaves resources for you. And on the Moat side, right, so strong infrastructure, nationwide fiber optics. So it's really hard to compete in this type of business because of the high barriers to entry. Of course, they have a dominant market share as being state-owned large telecom in the country. They have the government support. I would always say that a state-owned company is always a double-edged sword. So you want to balance shareholders on the one side and the country's development on the other side. I'm always cautious to use the company as a like a piggy bank for for example, what Petrobras did in 2010s, that they funded a lot of projects. There was a lot of corruption and a lot of wasted capital from the shareholders' perspective. Although the government is also the shareholder, so it cannot really destroy the shareholder because it is a shareholder. So I think they are striking a good balance, and they are balancing both. So they are not doing crazy projects, and they are rewarding shareholders, and they are managing their financials extremely well. So. And the other moat is, of course, the high switching cost. If you're logged in with the package, you don't want to lose one good deal on your mobile. Maybe you have a good mobile plan, and maybe a competitor is offering a better one, but overall the package is not as great. And also, like, I'm using T-Mobile where I live, and I know that one or two other competitors have better prices, but I've been using them since I have a phone, really, and I just stick to them. So management, state-owned majority, so it's strong ties with the government. It can be bureaucratic. What I don't like on their management is that I was looking at their annual report, looking for the governance report. I couldn't really find clear KPIs for their management, which is kind of sad because I want to see how much management is paid and what KPIs are they following, because you get what you incentivize. So they are focused on transformation, diversification beyond traditional telecom. So I think it's great. You see some potential business model breakers like Starlink. Although I would say Starlink is great, but it's not as competitive as of now as a traditional telecom. So I have a friend who doesn't have a normal line because he's kind of living on a hill, and he's using Starlink because of that. But there are issues which I don't face. So I have actually faster internet with just a traditional local internet provider, and he doesn't. And also, if he wants to download something, sometimes Starlink just doesn't let him download. So they spin off a couple their indie home to Telkomsol to streamline operations and improve efficiency. I think that's a great move. My fear is always with state-owned enterprises is that they just get bloated, and they just keep parts inefficient. The taxpayer can subsidize it, and you just don't want to fire people to lose votes, to have a bad number on your GDP or your unemployment. So that's not the case here. And if it would be the case, you would see it in the numbers. So the company is generally actually transparent, other than their management KPIs, and aligned with national development goals, paired with good shareholder management. So this is their target, realization of 2024 target and realization. So you can see what they are thinking about. Maybe this could be used as a proxy for their for their management compensation KPIs. So what they are focusing on, right? So they want to have revenue growth. It grew by 0.5, but their free cash flow grew more because they reduced capex. They want to have an EBITDA margin and net income margin. I think EBITDA is whatever. I don't like EBITDA that much, but net income certainly 16%. It's a nice margin for a business like this. And capital expenditure. So what their goal was, not 20 to 30, but 25 to 30% of revenue is planned for capex, focusing on building digital infrastructure. So it's a growth and not as much as maintenance. So that's also good if they can keep the maintenance part and actually grow the business and only spend 30% of their revenue. That seems reasonable to me. The realization was on the low end side, so 16%. And if you think about, this is a 24 report, annual report, and if you think about a couple slides before, we looked at their quarterly 2025 Q3 numbers, they are trending below actually their 24 numbers. So we will have a nicer capex even. and their dividend policy is clear cut. So they want a payout ratio of 60 to 90%. So that's amazing. So you have net income, and most of it you're just gonna pay it out. And actually in 24 they paid that out on the high end of the. And if you look at their shareholder remuneration history and debt, you can see that they are managing their debt quite nice. If you compare this to any telecom company, basically in the US or Europe, they are drowning in debt, which I really dislike. So that's I would like to invest in some of these companies, but usually the debt is something that scares me away. You can see they've been paying dividends rather every year, same level, up or down a bit, but very consistent. And then since 2020, you see their free cash flow has been really nice, and relative their dividends. They don't do buybacks, so that's something if you are looking for, you're not gonna find here. Total shareholder return. So this is something I think is really great, because if I go back here, you see that there is no buyback, no buyback, no buyback, no buyback. And now they mentioned share buyback program, right? So they have a budget of 3 trillion rupiah. I know it doesn't mean much. So it's basically would be like here, this much a buyback. And they are doing it for 2 years. So that's actually not that huge. Like Petrobras, I think Petrobras started to do buybacks in 2023. If they're gonna do it, nice. I would say it makes sense for the already existing shareholders, because the company is a bit undervalued. Both Petrobras a lot undervalued, and this company is also a bit undervalued. So it makes sense to not just pay out dividends. But of course, the governments want the cash flow usually, and it prevents these companies to just destroy capital by buying back expensive stocks. In this case, they wouldn't destroy capital. They are smart to do buybacks, although we'll see how much they will do, and maybe they just do a little like Petrobras and focus on dividend payouts. Either way, it's nice. And the company provides a guidance, which is great, revised guidance. So revenue to be flat to slight contraction, margins to be maintained, and then they say the capex to 17 to 19%. So this is already an improvement on their capex, because the previous 2024, if you recall, it was 25 to 30% of revenue, and they ended up at like 16.3. So they are targeting 17, 19. It's reasonable that they're gonna hit it, right? Because they are already trending below 24. So maybe they're gonna hit 15%. So that's great, not to overspend. So for the margin of safety, I would put their value around $25 for sure on my discounted free cash flow. I use the 3% growth rate going forward. As you can see, 2018 to 2024, they grew much faster if you do a compounded annual growth rate on this. But that's mainly because they reduced capex, you see here, and they increased their cash flow from operations. I use 3% growth. It's very conservative, I would say. And then you can see their 7-year and last year's 10 gap is pretty close, so you cannot really get far if you are not projecting huge growth rates. It's a decently profitable company. They have really nice return on equity and really nice return on investment for the business they are in, managing it with relatively low debt to equity, so the debt is manageable. Although the cost of debt is a bit high, right? Of course, because this is a higher interest rate country, it's a higher risk, it's an emerging market, and this is the reason why they cannot leverage up as much as, for example, a European telecom would. Of course, their coverage ratio is healthy. I would say above 5, it's okay. Maybe we could compare it to a European company. They usually have coverage ratios above 5 and healthy, because they have just so low the cost of debt. And then they don't have to be as liquid against current liabilities, because everything is like coming in, going out, coming in. So it's not like a iron ore producer where you have to, or like a gold company where you want to sit on a lot of cash. The dividend yield is around 6.6 to be precise, and their free cash flow yield, if I annualize their Q3 year-to-date numbers, are around 14%. So it's, if you are looking for a company that gives you 10% free cash flow yield, you are already there, so you have a margin of safety. There are some risks, right? So slow growth in legacy telecom services. Their biggest segment is mobile. Maybe some market disruptions from Starlink or the like. They have, I would say, mostly political risks. how the government interferes, maybe with pricing, maybe with less profitable projects. And then you have competition from foreign and private players. If they get complacent and don't improve or don't keep up their standards, they could lose market share. Overall, I would put DT Telecom to have around the 28% upside if you want to have a 10% free cash flow yield. So that's the name. The name is I want to get a 10% free cash flow yield without taking too much risk. And then you have to adjust for risks, right? So if you have a company that's riskier, you want to have a larger margin of safety or a larger meaning a larger free cash flow yield. And then you don't want to have too much debt. You want them to be liquid and profitable. So you also want to have a good business. As a summary, dominant telecom business in Indonesia, and predictable and essential for the country's development, and just the nature of the business. The moat is wide but maturing, so you cannot just lay back and not do your job. So you have to spend on growth, you have to spend on maintenance, and then you have to maintain your quality against competitors and risks to not be overtaken. Because you can see this is a nice margin for telecom businesses. This is on the profitable side, so you can expect foreigners to notice. Management is state controlled, focused on the country's growth, balancing it with the shareholder and the government growth. It's competent but can be bureaucratic because of the state-owned nature. Margin of safety, so it's consistent cash flow, profits, low leverage, reliable dividends, and our growth is depending on their growth and on their transition to the newer segments of telecom. I think current valuation is putting them to a nice price. So you have a margin of safety, you have a nice cash flow, a nice dividend yield, a nice dividend policy. So you will not 10x this company, but you can get a stable 14% yield as of Q3, and maybe if maybe capex goes down, revenue comes down, you would get to 10% plus free cash flow yield, and then their idea is to pay out 60 to 90% of net income. So you would get a 6, 7, 8% dividend yield where around that region. So it's not gonna break out 10x, but it's gonna provide you with a nice cash flow. So if you enjoyed this video, please like and subscribe, and let me know in the comments what else you would like to see. I'm kind of running out from the companies that I already researched. So I still have like 10 or something. Then I have to start researching new companies. If you have some ideas, please let me know. And see you later. Take care. Bye.